Hey, what is going on everyone? Welcome to another video. This video is going to be a 3-step framework from the daily bias, aligning it with the daily profiles and the daily wick size. So let's start with the introduction first. So before starting the video, thank you to T-Traders. I've learned all these concepts from him. So starting with the introduction, most traders are constantly second guessing their entries. They are going into the day and they don't have the idea of the daily bias, and then they are taking longs and shorts and they are guessing the price section, if it is gonna go higher, if it's gonna go lower. So I'm gonna remove this using this video, which is a 3-step mechanical framework. So starting with the first step, which is determining the direction of the daily candle. This will sound cliche, but I'm gonna explain it to you in detail. So the first type of finding a daily bias is liquidity based direction. You have to identify where the price is heading towards. The best objectives are the failure swings, the previous day highs, the previous day lows. These are the simplest draw on liquidities. So here is the example. I don't have a swing point or a weighted closure here, but if we reach a low, then we printed a bullish candle. So on this day, what is the most high probable draw on liquidity? So if I'm looking down, this is already a protected swing because it has purged that low and now the price wants to go higher. So for this day, my draw on liquidity is the previous day high, the high prior to that, and these failure swings. So the price is going to continue in that direction. This is the first form of finding the daily bias. Now the second is using the MMXM's next day model. MMXM next day model uses the PESA price delivery, and it uses the previous day highs and the previous day lows as easiest strong liquidities. So here is the schematic. For example, I have a swing point form at the lows. Now we have a candle 2-quarter. So according to the MMXM's next day model, the next candles, which are the candle 3rd, 4th, and 5th, will expand higher until the expansion threshold is reached, which is the 3 days max expansion, or the draw on liquidity is reached. So on the 3rd day, we took the previous day high, expanded higher. Now for the 4th day, we already expanded higher. And how do we know if this day is going to expand higher? I'm going to explain it to you in the next section. So for the 4th day, we already expanded higher. On the 5th day, we expanded higher. But what do we have? 3 days of expansion. So we are expecting another further price delivery, which could either be a reversal, then going lower, or a retracement, taking the previous day low inside this fair value gap and then going again higher. So for that, you have to print the next candle or use the daily profile if it is going to be an open low high close or open high low close candle. Now the third step is the T-Traders fractal model, which is trading the candle 3 up the swing point. In my opinion, this is the easiest way to find the daily bias, which avoids and removes the second guessing, and you have to wait for that second candle at the swing point to print and then trade the third expansion candle and the fourth expansion candle using the 50% of the previous candle's ranges. So in this case, I have the candle 2 of the swing point print. Until that, I'm not gonna touch the charts because now I have the direction. The candle showed rejection or reversal at the lows or some draw on liquidity or a point of interest. Now I'm expecting the third candle to expand higher. So what I'm gonna do is I'm gonna use the 50% of the wick. The only purpose for using that is if this candle is creating a large wick, it is gonna be a reversal candle and validating the idea of the expansion. If it is printing a small wick inside the 50% and upper quadrant of the previous candle's wick, it is going to be an expansion candle higher. So for the next candle, I'm still gonna use the 50% of this third candle and I'm gonna expect the next candle to expand away from that. So this is the easiest method to find the daily bias, letting the candle 2 of the swing point print, which is the lower probability candle to trade, which I'm gonna tell you in the wick section. Now the step 2 is aligning the daily profile with the daily bias. So this is once you have the direction of the daily candle, you have to use the change in the state of delivery on the hourly chart, which is the intermediate term time frame, to confirm that established low or high within the candle 2. So the condition 1 is if a reversal has put in prior to the new session, then the new session become a continuation opportunity. So I'm gonna show it in this schematic. So what do we have from the opening price? We created a small wick and this orange indicates the session prior to the New York session. What do we have? We use hop up the daily candles range, printing the wick and expanding higher. If it is an expansion candle, I'm going to expect a continuation higher in the New York session. So what do we have? From the opening price, we created a small wick, then expanded higher. Then starting the New session, we had a retracement, the first opportunity, and then we have this second opportunity. And we can use the hourly to 5-minute or 30-minute to 3-minute swing points to trade that, or use it alongside the 4-hour profile and trade it on the 15-minute chart. And we have a second condition where we have no reversal prior to the New York session, and the New York is reversing. So most of the time this occurs on the indices. So here we have a consolidation and opposing run prior to the New York session. And what do we have? We created that wick from the early sessions. Then going into the New York session, we confirmed that reversal by printing this reversal wick and then expanded higher because there was no expansion prior to the New York session. So I'm expecting the whole day's candle to be printed in the New York and afterward sessions. So in this case, what you're gonna do is you can let this candle print and then trade the continuation candle, like for example the 9 a.m. or 10 a.m. if it is a news or equities open. Or what you can do is divide this candle by half, let the first 30-minute candle print and then trade the continuation, which I'm gonna show you in the examples. Now step 3 is body and wick measurement of the daily candle. This is very important. So we have 3 conditions here. The first one is small wick with confirmed profile. So this is the high probability to trade because in reversal you cannot trade the expansion and the maximum objective as the opening price. Although when you have a small wick with confirmed profile, if the daily candle creates a small wick, then it means it will print a large body and we can trade that. So here is the example. We from the daily open created a small wick, a shallow run, confirmed with a change in the state of delivery on the hourly chart. If you are on a reversal candle, you will be already having that V-shaped reversal within the candle 2. If you are on an expansion candle or the candle third of the swing point, what you can do is let the low of the day print or high of the day and then trade the continuation. So in this example, we printed a small wick which leads to a large expansion. So what does it mean? So if you have watched my time in range within a candle video, we spent less time creating the wick lower and we have more time to expand. Less time in creating the wick, then it means more time to creating the body and expansion higher. And the condition 2, we have a large wick with established high or low of the day. This is trading the candle 2 of the swing points, which is lower probability compared to that expansion candle. So here is the schematic. What do we have? This is that reversal candle of the swing point on the daily chart. From the opening price, we created a large run. We don't have a confirmation if the price is going higher. Then we have a closure above the consecutive series of down close candles, which confirm that wick up the candle and reversal within the swing point. So what we can do is now trade the continuation, but the target for the continuation is the opening price of the candle. Why is that? Because we have spent most of our expansion creating that opposing run, then closing above that opposing run again. If you compare it to this price section, created a small wick, expansion, small retracement, another expansion. And in this case, we have used too much of the daily range creating the wick, and we have less range to trade higher. And if you have seen on the chart historically, when we have a large wick, then we have a small body. That means the candle has its distribution range. Like for example, let's say this is a 400 point range. So we use hop up it creating the wick, then we will use hop up it to create the body. So that doesn't make sense to trade the reversal candle. The expansion candle are always high probability, and this is the chart for the daily candles behavior. When we have a bullish expansion candle, it will create a small wick lower and then expect a large body higher. Bearish expansion candle, small wick higher, large body lower. Bullish reversal candle, large wick lower and then small body, are trading back to the opening price. Bearish reversal candle, large upper wick and then trading back to the opening price. So this is the table for that. Now we will go into the charts and I will show you some examples of how to align the daily bias with the daily profiles and avoid second guessing. So I'm gonna use some examples from the previous week or recent price section. So let's hop into the trading view. So starting with the first example on the gold here, what do we have on the daily chart? As you can see that we don't have an established swing point. The previous week expanded lower, then the Friday candle closed into the highs, which means a reversal higher. But starting the Monday candle, what have we done? So going into the nearby session when I'm on the daily chart, which is the nearest strong liquidity and which does make sense. So in my opinion, this, which is from the previous week Wednesday, this is the nearest strong liquidity. So this is the kind of the daily bias when you are using just the draw on liquidity or the nearest objectives is a sell side liquidity. So what do we have? If we are reversing from there and leaving this failure swing and going again higher, the daily range has already expanded much up its range. It created a small wick, then started expanding lower. It can't reverse from here and then go all the way up to here. So the nearest strong liquidity for me is this low on the Wednesday. So this is the daily bias when you are determining it by using just the drawn liquidities. So now dropping down to the hourly chart and then considering the wick size in the daily profile and seeing how can get inside with the distribution lower to these objectives. So now dropping down to the hourly chart, you can see I have the daily candles on the right side and this is our drawn liquidity. And going into the new session, does it make sense to go all the way from here to these failure swings are the nearest strong liquidity, which are these Wednesday low and previous day lows. So what the previous candle did, it created a high first, open high, and now we are expecting open high low close or a bearish expansion candle. So now going into the new session, this is 7 a.m. What do we have? We have a failure swing stacked up. So in order for a continuation lower, we need some kind of point of interest to tap in, and then we need that candle closure to trade that expansion lower. And one thing more, what do we have from the previous day? We have consecutive series up of close candle. We already have close below that. So that also means that now this is a protected swing and now we can trade away from it lower. So now we have multiple confluences, open high up the wick, daily profile supporting our idea. What is the wick size telling us? We have created a small wick. We have used less of a daily range creating the wick and now we are gonna print the body lower. So now going into the new session, we will see what the price action is doing. So now this is the draw on liquidity. The price started expanding higher. This is just a retracement into this fair value gap. How do I know? Because I want to see a reaction at this level, because this is that previous fair value gap. If we are truly expanding lower, we want to create a small wick here and then starting expansion lower. So now letting the next candle print. So now what the next candle did after retracing higher, it took all these failure swings, tapped into a fair value gap, and now it is going lower. So this was also the trade which I took this week on Monday, which was about 6R. So now I'm gonna drop down to the 5-minute chart and show you how you can truly align the expansion lower. So now dropping down to the 5-minute chart, you can see we fractalized daily bias into 3 steps. The first one was determining the drawn liquidity, which is one kind of finding the daily bias. Then we aligned that with the daily profile and the wick size. The wick size was smaller and the daily profile was open high low close or a bearish expansion, and we have a reversal put in prior to the new session, which we can expect a new continuation. So now dropping down to the 5-minute chart, this is that hourly fair value gap and we have tapped that. And what do we have? If we use the wick logic again, from the opening price we created a small wick and then close below the consecutive series of close candles, which is that change in the state of delivery within the candle 2. If I'm waiting for the candle 3, it is not gonna provide me an entry or I'm gonna be late, because what have we done? We created a small wick within the reversal candle. If the reversal candle is creating a large wick, then we are expecting continuation candle to create a small wick. But in this case, we have created a small wick within the reversal candle. So I can get inside with the distribution here, putting my stop loss above the highs or the bodies, because at this point, if the price is reversing higher, that is already going to invalidate my idea, and targeting this low, which was that Wednesday low, which is about 4.22R, and we have expanded lower to that Wednesday low. And as you can see, this was that expansion candle, created a small wick, then expanded lower. And then for the next candle, we already have created a small wick, then again expansion lower. Now we are on the same gold chart and we are viewing the Tuesday candle. What the Tuesday candle did, this was a drawn liquidity, a relevant swing on the chart because the next swing point lies right there and the next one lies there. So this is a good spot for the market to change the feather price delivery. So what have we done? We reach into that objective from the opening price. We have created a large wick lower. So now can we expect an expansion higher? No, we cannot because we have used most of the daily range creating the wick up the candle and it is not gonna go all the way higher to the current day high or the previous day high because the daily range has its exhaustion point. So we use most of its range creating the wick, and now we are gonna go to the opening price or way lower than that, and this is how we avoid the lower probabilities or the reversal days. So now dropping down into the 1 hour chart and see what this candle has done. So now dropping down to the hourly chart, you can see that was the Tuesday's candle. Can we trade it lower to that draw on liquidity? Yes, absolutely we can. If you are an early session trader, you can trade it lower to those objectives. But if you are a newer session trader, the price action is revealed by the newer session. So you can see that from the opening price, we created a shallow run higher, then went lower, but we have reached an objective, which means we are reversing. So for a reversal candle, we have created a large wick lower. So it means the price is not going to expand to the current day high or the previous day high because it has used most of its range, about 132 point creating the wick. So it is now gonna go to the opening price are way lower than that, so letting the price action play. And as you can see, the price created a large wick lower and it went higher back, not even reaching the opening price. So this is how you are letting the wick up the candle sprint, and then we are trading the expansion candle higher. Now in this example, we are going to use the T-Trace Fractal model, trading the candle third up the swing point. So what do we have? We are in an uptrend. We retrace into this fair value gap. The price retraced into that and started expansion higher, created that wick. So this means this is a reversal candle. So now we are going to expect the next candle to be an open low high close or a bullish expansion candle. So what are the steps? We need a change in the state of delivery and a daily profile alignment. So dropping down to the 1 hour chart, we do have a candle 2 closure on the highs, but why I'm not shorting that? Because we have failure swings on the highs. We have left these equal highs and we are trading away from that. So in order for the price to expand truly, it needs to take those equal highs, and we do have a candle 2 closure. I'm gonna remove this fair value gap and we will see what the next day is doing according to the daily profile. Is it creating a large wick? Is it creating a small wick? Is it invalidating the idea? So we are going to see that. So going into the next day. So now going into the next day, you can see the early sessions. What have we done? We have created the low of the day, consecutive series of down close candles followed by a closure above. Why am I not waiting for this consecutive series and the candle 2 to be closed? It has already closed going into the newer session. So now going into the newer session, we do have consecutive series of down close candle. In the previous day, we closed above that, and we are also closing above the 50% of the previous day's range, which means we have invalidated the idea of a bearish expansion, and now we are going to go higher. So now we have an intraday low in the London session. We have SMT divergence at this close. So now we are going to expect an expansion higher because our criteria from the framework is meeting. First, we need a daily bias. We have a candle 2 closure from a fair value gap, internal to external range liquidity. The second one is aligning the daily profile. We have created the low of the day within the London session. The third one is the wick size. We have printed a small wick, so it means we are gonna print a large body. And where is the strong liquidity line? It is those equal highs on the top. So we can target that. We are at 9 a.m. So if the 10 a.m. is going to expand higher, which is the next 4-hour candle, the best spot for it is this fair value gap. So we need an open low high close, our bullish expansion 4-hour candle, or we need the next 1-hour candle, which is the 10 a.m. open, to create its wick from this fair value gap and then go higher. So now dropping down to the 5-minute chart, you can see this is that daily high. So from the opening price up the 9 a.m. candle, we are creating bunch of failure swings. So the best spot is the 10 AM reversal higher. So letting the next candle print. So this is the 10 AM open. We created a small wick inside that fair value gap. In order for a true expansion and the reversal confirmation, we need a closure above the consecutive series of down close candles within the candle 2. And with the next candle, we have closed above the consecutive series of down close candle, also creating a small wick. Why am I not waiting for the candle 3? Because the candle 2 has already shown its intention for expansion, creating small wick, and now we are going to print a large body. So I'm going to get inside with the distribution with the next candle, putting my stop loss below the bodies and targeting that daily high. So now what do we have? We have a consolidation range right here. So in order for the next candle to expand higher, we need to take the consolidation range low, then create the change in the straight up delivery, and we can get inside with another entry. So now this is an extra step. In a continuation, we have a consolidation followed by manipulation. A candle took lower, but this candle has a large wick, so we are gonna wait for the next candle to print its low, and then we can get inside with another entry going into the close. In the next candle, we have printed a small wick, and now we are going to expect an expansion higher, so getting inside with this entry too. Finally, we reach into those objectives going into the close, which was around the 15. This was aligning the daily bias, which was that candle third up the swing point. The candle 2 was created from this fair value gap, and we were expecting the candle third to expand higher. What are the criteria? The first one is the daily bias identification. We have a candle 2 closure expecting a candle 3 expansion. The second step was aligning the daily profile. So what do we have right here? A nice market maker model. We have equal highs on the top, and going into the new session, we had a change in the straight up delivery, confirming the candle 2 reversal. We have a small wick and established low of the day within the London session, and we traded the continuation higher. So this is how you can trade the true expansion candles. Now we are gonna hop into another example. So now going into another example, we are on the EURUSD daily chart. As you can see, we have a candle 2 closure, taking the previous candle low and this range low on the GBP/USD, which was confirmed by the SMT divergence. The SMT divergence only confirms the swing point. So we have a failure swing right here. We have taken that on the GBP/USD, so we can say that was a manipulation on the GBP/USD, and we are expecting the next candle to expand higher. And also, as you can see, we have failure swings on the highs. This high is not taking the previous candle high and not that high. So this is our draw on liquidity and these failure swing, and we are trading from external to these fair value gaps and the failure swings. So this is my bias going into the day, a valid candle 2 closure and expecting the candle 3 to expand higher. So in order for the candle 3 to expand higher, what we are expecting, we need to respect the 50% of the previous candle's range, and we need a weighted daily profile, creating open low first with a small wick and then trading that large body expansion higher. So dropping down to the 1 hour time frame to confirm that. So now dropping down to the 1 hour time frame, as you can see, we have printed a reversal candle on the daily chart, and we have confirmed it through the change in the straight up delivery, a candle 2 closure, a bullish expansion candle, down close candles followed by closure above. So this confirms the reversal within the candle 2, and we are going to expect a continuation higher. So in order for the continuation higher, first we need to align the daily profile, either Asian reversal, London reversal, or New York reversal. So now going into the New York session, as you can see, we have consecutive series of down close candles into this fair value gap, followed by a closure above. So it means in Asian reversal, it confirms low of the day. And what do we have? We have a very small wick, so that means a large expansion. But going into the new session, we already have met our objectives, so we are going to wait for the next phase of price delivery. If it is going to be a reversal, then it's going to go to the opening price again. If it is going to be an expansion again higher, so it means it will retrace lower, then provide us a swing point, and then we can get aside with the distribution again higher to the current day high. So this is our idea for now. So now going into the New Year session. Now going into the New Year session, as you can see, after reaching that high, what have we done? We retrace into this hourly fair value gap. And also we have a continuation purge taking these lows, and we are having a candle 2 closure. So we can now again expect an expansion higher. Why is that? Because we have a small wick, and that means the candle body is going to be huge or bullish and to these highs, and the expansion candle are closing into the low. So that means We are not going to close here. We have a retracement. We are going to go back higher above these objectives and close this candle's body bullish or an expansion candle. So on the 9am candle, which is the new 4-hour open part of the Forex, we have printed the candle 2 closure, and we are expecting a candle 3 and candle 4 expansion to that high, which is the least strong liquidity because we have already expanded too much. So dropping down to the 5-minute chart. So now dropping down to the 5-minute chart, can we trade this reversal candle? Absolutely we can, because it is having a relatively small wick and we have a change in the state of delivery confirming the reversal within that candle. But let's say we have missed that entry and we are waiting for a continuation. So going into the 10am open, we need an opposing run followed by a closure above and then trading the continuation higher. The best spot can be this fair value gap in the price section. We are going to retrace into that and then we are going to trade an expansion higher. So letting the price action play. So now we have created a swing point. In order for the expansion higher or confirming the continuation order block, we need a close above these down close candles. So the price failed to close above those down close candles. So we are going to wait for the next candle. So in the candle third of the swing point, we have an expanded higher. We failed to expand and close above these down close candles to confirm that continuation order block. Now what is the next spot for us to expand higher, which is the previous candle low? We need to take the previous candle low, then we need a close above the down close candle and we can get inside with the continuation entry. So now going into the next candle, which is the 11am, it took the previous candle's low. Now if we are closing above this down close candle, then we are going to trade the continuation higher to that drawn liquidity. And with the next candle, we have created a small wick, taking the previous candle low or tapping another fair value gap. And now we have a continuation entry, entering there, putting my stop loss at the wick lows and targeting that high. And as you can see, the price expanded higher into those highs because in order for the daily expansion candle to print, we need to close into the highs. So why I traded the continuation entries after the objectives, because we reached into this objective, we had a retracement, a reversal candle. The candle third of the swing point failed to expand higher, and then we traded the candle fourth, which took the previous candle low, created a small wick, and then expanded higher into the objectives within the same candle. So this is aligning the three-step framework. We had a candle 2 closure, a candle 3 expansion bias. It created a small wick, supported the expansion idea. Do we have a valid daily profile? Yes, we have. We have an Asian reversal with a small wick and then newer continuation higher. And why we traded this entry? Because if the daily candle is truly expanding higher, it is gonna close into the highs, and we traded that entry. So now hopping into another example. So now hopping into the NQ daily chart. This is the price section from the current week. This is the trade which I took a loss on. So what do we have from the Monday's candle? We don't have a bias because we don't have a swing point to trade away from. So we were continuously expanding higher. On a Wednesday, we had FOMC press conference on 2:30. So on weeks like this, when we are trading away from the unestablished low of the week, we are expecting the FOMC or midweek reversal profile, because the Monday and Tuesday are going to create that wick up the weekly candle, and then we can expect a Wednesday and Thursday continuation lower. So going into the Wednesday's price section, what have we done? We have taken the previous candle high with a relatively small wick, which means this is going to be a reversal into expansion candle. And what are the objectives? In the FOMC days, we have very high volatility, so we can expect a visit to the current week low, our unestablished low of the week. So now dropping down to the hourly time frame and implementing that idea. So now dropping down to the 1 hour time frame, as you can see, this is the unestablished low of the week. We are continuously expanding higher, creating the wick up the weekly candle, huge wick higher. Then we can expect a visit back to the opening price. This is the same wick logic. So on the FOMC days, I'm not trading the newer session. So this is the 2 a.m. open. So I'm going into the FOMC with a bias. So what is our bias? From the daily opening price, we went higher, created the high of the day first. And how do we confirm it? We have a closure below this up close candle, which confirms the change in the state of delivery. And now we can expect a continuation lower. So going into the FOMC, what have we done on the 14 candle? We have took this consolidation range high, or continuation purge. we tapped into this change in the state of delivery, took a high, and now we can expect a continuation lower either to this, which is that Tuesday low, or the current week's low. So dropping down to the 5-minute time frame and see what happens. So now dropping down to the 5-minute chart, as you can see, we have created a small wick on the 2am candle, taking all these highs. So in order for the expansion lower, what do we need for an entry? A change in the state of delivery. So we have consecutive series of up close candles, so we need a closure below that, and then we can expect FOMC to go lower. So we need a closure, and on the next candle we get a closure through the consecutive series of up close candles reaching to those highs, or this candle too. So I entered on the next candle right here, and I put my stop loss at the 50% of the wick, which was a wrong move, and I targeted about 3 hour. What the price did going into the FOMC, it wicked me out at 1430 and then expanded lower into my target. So this was the wrong stop loss placement, considering the volatility and the FOMC press conference. I should have put my stop loss at the high. That was a stop out over a trade, and I learned from that. So this is how you can like align the daily profile. So what was the daily candle doing? It created a small wick relative to the FOMC volatility, and then we were expecting a return back into the weekly open or the Tuesday low. So the whole purpose of this video is aligning those 3 steps to get inside with the true expansion. The first one is the daily bias idea, then the daily profile confirmation, and the third one is aligning the wick size with the daily profile. So I hope you guys have learned something from this video. Thank you guys for watching. Make sure to subscribe to the channel and like the video, and see you next week.